Have you ever had that feeling, that nagging sense that the financial ground beneath your feet isn't quite as solid as you've been told? That the value of the money you work so hard for seems to buy a little less each and every month? Welcome to Bullion Signal, the podcast dedicated to navigating the complex world of macroeconomics, precious metals, and the preservation of your wealth. Today, we're peeling back the curtain on a recent quiet move by the Federal Reserve. It was a move that barely made the evening news, but one that many analysts believe has fired the starting gun on a massive transfer of wealth. We're going to explore what they did, why they did it, and what it could mean for the future of your assets. If you find this analysis valuable, make sure you're subscribed to Bullion Signal so you never miss a critical update. So let's just get right to the heart of it. The big multi-trillion-dollar question that underpins our entire discussion today is this: is the money printer on again? Now, you won't hear it phrased that way in official press conferences. You'll hear technical jargon, words like liquidity and balance sheet adjustments. But what we're really asking is whether our central bank has resumed the process of creating currency out of thin air to finance government spending. And according to a growing number of observers, the answer is a resounding yes. To understand why they might be forced to do this, we need to confront a truly staggering number. $38 trillion. That is the current U.S. national debt. It's a number so vast it almost loses meaning. But think of it this way. It's a debt so large that the interest payments alone are becoming one of the largest expenses in the entire federal budget. This isn't just a number on a screen. It's a financial trap. And the source material we're analyzing today argues that this debt trap is the very reason the Fed's hand is being forced. Okay, so with that massive debt hanging over everything, let's drill down into the specific catalyst for this entire debate. It wasn't a loud, dramatic announcement. In fact, it was quite the opposite. It was a quiet, almost buried statement from the Federal Reserve that they would once again begin buying government debt. And for those paying close attention, the alarm bells started ringing immediately. This is where we see two completely different stories emerge. The official narrative from the Fed was that this was just a technical adjustment. They said it was about providing liquidity, basically just making sure the banking system has enough cash to operate smoothly day to day, a routine bit of financial plumbing. But the other narrative, the one we're exploring, says that's just a convenient label. It claims that this is quantitative easing, or QE, just dressed up in a different suit. A smokescreen to hide the fact that they are once again monetizing government debt. So what exactly is quantitative easing? Let's put the jargon aside. Imagine the government has expenses it can't pay for with taxes. It issues debt, an IOU. Normally, investors buy that debt, but when the debt gets too big, investors get nervous. Under QE, the central bank steps in. It creates brand new digital dollars that didn't exist before and uses them to buy the government's IOUs. In essence, it's a way to turn debt directly into cash. It funds government spending not through taxes or honest borrowing, but through the creation of new currency. And this brings us back to the why. Why would they do this? This section explains what's called the national debt trap. The source argues that this wasn't a choice, it was an inevitability. When a country's debt grows so large, there comes a point where the only entity big enough and willing enough to keep buying that debt is the country's own central bank. The government needs money, and the Fed is the only one who can create it on demand. So, what does this mean for you, for me, for anyone who holds dollars? This is where it gets personal. The analysis calls this process a direct theft of your purchasing power. Think about it. If there are $100 in existence and you have one of them, you own 1% of the money supply. But if the central bank creates another $100, there are now 200 in existence. Your $1 is still just $1, but you now own only 0.5% of the money supply. The value of every dollar you've saved has just been diluted. It's an invisible tax that erodes your savings without ever sending you a bill. Now, smart money understands this. When people sense that the value of their currency is being deliberately eroded, they don't just sit there and watch it happen. Capital is like water. It flows away from danger and towards safety. So the question becomes, where is that capital flowing right now? And the answer, as we'll see, is a tale of two ancient and very physical metals.
Just take a look at these numbers. They are truly astonishing. In the period measured, gold is up a massive 64%. But then look at silver. It has more than doubled, an absolutely explosive move of 113%. Meanwhile, Bitcoin, often called digital gold, is actually down 5%. The market appears to be screaming a message here. It's a flight to tangible, time-tested stores of value. It's a move away from promises and towards physical assets.
Why this dramatic shift? The source highlights a crucial concept: counterparty risk. Almost every financial asset you own, a stock, a bond, even the cash in your bank account, is a promise from someone else, a counterparty. You are trusting that company not to go bankrupt or that government not to default. Gold and silver are different. A physical ounce of gold in your hand is not a promise from anyone. It is the asset. It has no counterparty risk. Its value doesn't depend on a CEO's performance or a politician's promise. And in a world of broken promises, that becomes incredibly attractive. While gold's performance is impressive, the analysis we're examining really zooms in on silver. It argues that silver is not just riding gold's coattails. No, silver finds itself at the center of a unique convergence of factors, what can only be described as a perfect storm. This perfect storm has four key components hitting all at once. First, an industrial demand shock. Silver is absolutely essential for green technology, solar panels, electric vehicles, you name it. Second, a supply shock, with some of the world's biggest producing nations signaling they may hold on to their silver rather than export it. Third, surging monetary demand from investors like we just discussed, who see it as undervalued money. And fourth, all of this is happening on top of a pre-existing supply deficit. The world was already using more silver than it was mining before these new shocks hit. And this isn't just a theory crafted by analysts looking at charts. We're seeing real-world confirmation on the ground. The analysis quotes a mining CEO who says that for many companies that primarily mine for things like lead or zinc, silver has suddenly gone from being a small byproduct to a real, meaningful contributor to their profits. As a result, these companies are scrambling, pouring money into accelerating their drilling programs. When business behavior changes this drastically, you know the underlying market dynamics have fundamentally shifted. So, is what we're witnessing today a completely unprecedented event? Or are we simply seeing a familiar pattern play out, an echo from the past? The final part of this analysis suggests that if we look back through history, we can see that these types of events often occur in cycles. Now this is fascinating. The source brings up something called the Benner cycle. It's a market forecasting model that was created by a farmer back in the 1870s. And what's incredible is its track record for predicting years of major market panic. It pointed to a period around 1999, the dot-com bubble. It pointed to 2008, the Great Financial Crisis. It pointed to 2019, which saw major market panic. According to this historical cycle, the next major crisis period is forecast for 2026. And that leads us to the most sobering historical parallel in the entire analysis. It draws a direct line from our current situation, with unpayable debts and a central bank monetizing them, to Germany in late 1921. Now, this was the moment just before the infamous Weimar Republic hyperinflation that completely destroyed their currency and society. The crucial point is that the leaders at the time felt trapped. Politically, they felt they had no choice but to keep the printing presses running to pay the government's bills, even as they saw the disaster was creating. It's a terrifying reminder of how quickly things can spiral out of control. So, what's the takeaway from all of this? We've seen how a quiet policy shift from the Fed, driven by a massive national debt, may have reignited the money printer. We've seen capital fleeing from currency and into hard assets like gold and silver, with silver caught in a perfect storm of demand. And we've seen historical cycles and parallels that suggest we may be entering a period of profound financial instability.
The analysis we've covered today leaves us with one final critical question, and it's one I'll leave with you. Are you prepared for what's coming? Thank you for joining us on Bullion Signal. If you found this breakdown insightful, please like, share, and subscribe so we can continue to bring you this vital information. And as always, remember that this content is for informational purposes only. It is not financial advice. Please do your own research and make your own informed decisions. We'll see you next time.